The minimum payment illusion. You see that minimum payment of $47 on your credit card statement and it feels manageable. You can swing $47. What you're not seeing is the interest rate of 24.99% working against you in the background like a financial termite. The minimum payment illusion is designed to keep you in debt forever. Credit card companies don't want you to pay off your balance. They want you making minimum payments for decades while compound interest turns your $3,000 target run into $6,000 paid over 12 years. This is how the middle class stays trapped. A $5,000 credit card balance at 22% interest with minimum payments takes over 20 years to pay off and costs you over $10,000 total. You're literally paying double for everything you bought, and the entire time it feels affordable because, hey, it's only $89 a month. The math is deliberately obscured. If credit card statements said, you'll pay us $11,000 over 18 years for this $5,500 balance, people would revolt. But because it's framed as a small monthly obligation, we sleepwalk into financial bondage. The sale trap. You walk in for laundry detergent and suddenly you're walking out with 3 throw pillows you don't need because they were 40% off. Congratulations, you just saved yourself into being broke. Here's the psychology. Your brain doesn't register, I spent $60 on pillows, it registers, I saved $40. But here's the thing, you didn't save anything. Saving means money stays in your account. What you did was spend $60 that would have stayed in your checking account if you just walked past that end cap display. Retailers know this. They're not offering discounts out of generosity. They're offering them because getting you to spend $60 you weren't planning to spend is better for them than you spending $0. The middle class falls for this constantly because we've been conditioned to believe that getting a deal is the same as being financially smart. It's not. Being financially smart means buying what you need, when you need it, at the best price you can find. It doesn't mean stockpiling items because the per-unit cost was attractive. The lifestyle creep. You finally get that raise you've been working toward for 2 years. You're making $65,000 instead of $55,000. Finally, you can breathe, right? Wrong. Because within 6 months, you've upgraded your apartment, you're eating out 3 times a week instead of once, and suddenly that extra $10,000 has evaporated into lifestyle creep. This is the invisible trap that keeps middle-class Americans comfortable but never wealthy. Every time your income increases, your spending rises to meet it. You get a better car because you can afford the payment now. You move to a nicer neighborhood because you deserve it. You upgrade from basic cable to the premium streaming bundle. None of these decisions feel reckless in isolation, but together they ensure that the gap between what you earn and what you spend never widens. You're just comfortable being broke at a higher salary. The problem isn't the spending itself, it's that you're not capturing any of that income growth for wealth building. Your 35-year-old self is living exactly as tight financially as your 25-year-old self, just with nicer stuff. The wealthy do the opposite. They increase income and keep expenses relatively flat, funneling the difference into investments and assets that compound over time. Being house poor. You get pre-approved for $450,000, and suddenly you're looking at houses at $445,000 because the bank said you could afford it. This is the house poor trap, and it's a financial prison with a 2-car garage. Banks calculate what you can technically afford based on debt-to-income ratios. They don't calculate what you should buy based on having an actual life. So you buy the maximum house, and suddenly you're paying $2,800 a month in mortgage, plus $400 in property taxes, plus $200 in insurance, plus $150 for HOA fees, plus maintenance that averages 1 to 2% of the home's value annually. You're spending $4,000 plus per month just to keep a roof over your head. That's before utilities, before groceries, before the water heater dies. You can't save for retirement, you can't take vacations, you can't absorb financial shocks. You're working to maintain a structure, not to build a life. The smart play is buying below your approval amount, way below, so you have room to actually live and invest. Co-signing loans. Your brother-in-law asks you to co-sign on his car loan because his credit's not great right now, but he's got a good job. Here's what you just agreed to. You're now legally responsible for his debt. If he misses a payment, it hits your credit. If he defaults entirely, the bank comes after you for the full amount. Co-signing feels like helping family. What it actually is taking on someone else's financial risk without any upside. The bank wouldn't lend to this person without a cosigner because their data shows this person is a risk. You're not smarter than the bank. You just care more about this person than the bank does. That's noble, but it doesn't change the math. If they default, and statistically many will, you're stuck paying off a 2019 Camry that someone else is driving. Your credit score tanks. Your debt-to-income ratio worsens. You can't qualify for your own loans when you need them. All because you wanted to be supportive. The low ROI student loan trap. Not all degrees are created equal financially, and taking out $80,000 to get a degree in a field where entry-level jobs pay $38,000 is a trap that cripples wealth building for decades. The calculation is simple. How much debt am I taking on versus what will I earn? If you're borrowing $100,000 to become a doctor earning $200,000, the math works. If you're borrowing $75,000 to enter a field paying $42,000, you're underwater before you start. The loan payments become a permanent fixture in your budget, preventing you from saving for retirement, investing for retirement, or building emergency funds. I'm not saying don't pursue your passion. I'm saying understand the financial trade-off you're making and plan accordingly. Maybe that means going to a cheaper school, working part-time during school, or pursuing certain degrees only if you can minimize debt. The car payment treadmill. You trade in your car every 3 years to keep the payment at $450 per month. You're never without a car payment, and you're never building equity. This is the financial treadmill that the American middle class runs on until retirement. You trade in a vehicle with remaining loan balance, roll that negative equity into a new loan, and restart the clock. You're perpetually paying interest on a depreciating asset and never reaching ownership. After 20 years of this, you've paid over $100,000 in car payments and interest and own nothing. The wealthy do the opposite. Buy reliable used cars, pay them off, and drive them for a decade while investing what would have been car payments. A $450 monthly payment invested at 8% for 30 years becomes over $600,000. That's the actual cost of staying on the car payment treadmill. It's not just the car. It's your retirement. Timeshare commitments. You sat through that timeshare presentation for the free weekend in Orlando. You walked out owning a piece of a condo in Fort Lauderdale that you can use 1 week per year. Congratulations, you just bought the worst investment in America. Timeshares are marketed as vacation investments. They're actually depreciating liabilities with perpetual costs. You paid $22,000 up front, and now you owe $1,200 annually in maintenance fees that increase every year. You can use the property 1 week, usually during off-peak times, assuming you book far enough in advance. And if you try to sell it, good luck. Timeshares lose value immediately and are nearly impossible to unload. People literally try to give them away online. You're locked into paying maintenance fees for something you use 2% of the year and can't sell. It's not an investment, it's a financial anchor. Predatory payday loans. You need $400 to cover a bill before your next paycheck, so you walk into a payday lending store. They give you $400 and you write them a check for $460 post-dated to your next payday. Seems manageable until you realize that's 15% interest for a 2-week loan, which annualizes to nearly 400% APR. The payday loan trap is a debt spiral. You can't afford to pay back the full amount when it's due, so you roll it over, taking on more fees. Soon you're taking out new loans to pay the interest on old loans, never touching the principal. What started as a $400 emergency becomes a $1,200 hole you can't climb out of. These lenders target middle and lower income neighborhoods specifically because they know people are desperate and don't have access to traditional credit. Investing in depreciating assets. You buy a boat because it was your dream, and you tell your spouse it's an investment. It's not. It's a depreciating asset, and confusing liabilities with investments is how the middle class stays broke. Real investments appreciate or generate income. Real estate generally appreciates. Index funds compound over time. A boat loses value the moment you drive it off the lot, costs money to maintain, costs money to store, and generates zero income unless you're running a charter business. Same with luxury cars, designer handbags, and high-end electronics. They're consumption, not investments. And that's fine. You're allowed to buy things you enjoy, just don't lie to yourself about what they are. When you call consumption an investment, you justify overspending and avoid making actual investments that build wealth.